Greg Mannarino's top market signal explained. So it's the MMRI, and if you're a fan, you know that is kind of the basis of what he uses. Basically, you are comparing, you are looking at the DXY, which is the dollar index, and the 10-year yield. So Justin, do you want to take it from here?
Absolutely. So what I've done is, if any of you follow Greg Mannarino, if you don't follow Greg Mannarino, by all means, subscribe to him immediately. He is definitely a good person to follow. But one of his go-to things as a market indicator is the Mannarino Market Risk Indicator, the MMRI. And Josh, if you go ahead and cue up the slideshow that I've got. There we go. So if you go to his website, traderschoice.net, click on About, you'll scroll down maybe about a third of the way through the page and you see this. This was capped earlier today. And so the key thing for the MMRI is that Mannarino looks at demand for dollars, demand for debt, and he has a number ratio that he just divides it by to give a indication of risk in the market. So it's kind of like dig into this a little deeper. So what Mannarino does is he looks at the relative strength of the dollar via the Dixie, as well as demand for 10-year treasuries. Now let's pause for a second and just remember that bond prices are yield on bonds is inversely correlated. So the more people want bonds, the less they yield. And the less they want bonds, or the more they sell them, the more the yield rises. So this is the formula explained right here, but I think a graphical representation is actually a little bit easier to consider. And so what I've tried to poorly draw here is on the left-hand side, you have dollars. So think of that as an asset. The green.
These are dollars against other currencies, though, on the Dixie.
Exactly. Even though the dollars against other currencies on the Dixie, what it does suggest to me is that do people want to hold value in their native currency, or do they want to hold it in dollars? It's kind of like the inverse of Brent Johnson's dollar milkshake theory. More on that in a second. But the point is that the way I kind of view the green part is, do people want, or does the average person want dollars, or do they want to sell dollars? In other words, is DXY strong or is it weak on the whole? The blue side are bond yields, specifically 10-year treasury bond yields right there. And then 1.61 on the bottom represents the number that Mannarino divides it by. I can't comment on the 161. That is way above my pay grade, but nonetheless, that is how Mannarino set it up. So one of the things that Mannarino oftentimes talks about is risk on versus risk off. And he'll also go through the idea of, as long as it's risk on, you want to be long the market. And the way I see risk on when I look through the MMRI is that people fundamentally don't necessarily want the asset. That is, they don't necessarily want the dollar. They'd rather hold euros, yen, whatever, versus dollars. And at the same time, they also want the unit of debt, the US treasuries. Hence, treasury yields low, DXY, dollar demand low as well. But the key takeaway from all of this right here in a risk-on environment is that the top part of the equation is small. And if you can only know one thing about the MMRI, I would suggest you think about it like this. The top number is what matters, and the top number is derived from two numbers. Just a really fancy way of saying the bigger the top number is, the more risk Mannarino would assert that there is in the market. Likewise, the smaller the top number is, the less risk that Mannarino would, I think, would assert in the market.
Yeah, so what Mannarino is essentially looking for is a weak dollar on the Dixie, along with a stable 10-year yield that is low. He wants to see yields. He often says that he does not want to see yields volatile in either direction, but you want to keep them low.
Yeah, exactly. And that's kind of what I tried to draw right there, if you want it to be spelled out for that front. Or if you want kind of more of the high level overview, this is also the way I kind of think about it, where that number on the top, again, large means more risk, small means less risk. It's a takeaway from that. So Josh, we just looked at a low risk, pardon me, we just looked at a risk off, Josh, we just looked at a risk on environment. And now if we scroll forward and look at a risk off environment, this seems to, at least to me, to have some parallels to Brent Johnson's dollar milkshake theory. So in the risk off environment, dollars are rising. That is, the DXY is rising. People are selling whatever the local currency is and buying dollars. And at the same time, people who hold treasuries are dumping treasuries, which causes the yield on treasuries to rise. Either way, Josh, both of these cause the number at the top to get bigger in the MMRI equation. And I can't speak with any authority to what Brent Johnson talks about with 10-year treasuries, but I have done my best to try to follow him in terms of his dollar milkshake theory, which basically suggests that the dollar being the cleanest dirty shirt, or as Rick Rule would say, the prettiest mayor at the slaughterhouse, Point is, foreigners would dump the local currency to jump into dollars, which would actually strengthen the dollar. At the same time, if people are dumping their treasuries, again, I can't speculate as why that would be the case, but for whatever, right? They want to get out of the debt market. This would increase the risk that Mannarino, I believe, would assert would be in the market. And the other thing too, and this is something that I believe Greg on, but again, I lack the insight into the education to connect the dots here. But just to call people's attention to it, Mannarino oftentimes says that the next meltdown blow up will happen in the debt market, not necessarily in the equities market. Again, he cites that the pricing in the equities market is a derivative of the debt market. That's probably an important thing to be able to explain. I wish I could. I can't, at least not yet. But nonetheless, I wanted to call attention to it. So again, you have this risk off thing where people want dollars, the green on the left, and at the same time, they're dumping their treasuries, blue on the right, causing both those numbers to increase. And again, just to reiterate the point, this would cause the number at the top to get larger. The number at the top getting larger means the MMRI goes up. The more the MMRI goes up, the more risk there is in the market. And Josh, I think you've done some historical work on this, but before we jump to that, I will note, I think on this past Friday, that's the Friday after Thanksgiving, I want to say we maybe brushed up against 100. We currently have fallen back down, as you can see, but that's the highest I think I've seen it ever since Mannarino started publishing it. Basically what Greg is saying, or as I understand it to be, is when people are fleeing to the dollar from the foreign currencies and then fleeing out of treasury bonds, you're going to see that's when risk is the most intense in the market. So this is a trading view right here. The bottom right here in yellow, this is the MMRI. The lower the yellow number is, the less risk that there is. Up here in the green, this is VIX. The blue is the Dow Jones. Purple, 10-year treasury yields. Here's what's fascinating. This is COVID 2020, March 2020, when the market kind of realized what's going on. The VIX immediately shoots up. And Josh, I think it was the 18th, Friday the 18th of March, give or take a day. My memory might be a little off there. That's when, the bloodbath really, had its a day in the sun. But the thing that's interesting is that if you look at treasury notes went down.
Well, yeah, people are buying the safest asset, and that there's also been a negative correlation from stocks to bonds for the past 40 years. So that is where you go when shit hits the fan. You buy treasuries. That is why the MMRI I don't think makes as much sense, because if we're having a deflationary bust, especially with euro dollar futures curve that just inverted, suggesting that yields are going to continue lower, if yields are going lower, the quote unquote MMRI is going to continue to go lower, which means Greg Mannarino is going to say risk in the market's decreasing, but that might not be the case. If we're having a deflationary bust, then risk could be actually rising.
When you see a risk-off environment as defined by people fleeing to dollars, with the DXY going up, Brent Johnson's dollar milkshake theory, as well as people dumping treasuries, that probably means the shit's about to hit the fan, per Mannarino. That's how I see it. Or said another way, I mean, based upon this, you would continue to buy the dip or buy the dips for the past few days.
Yeah, if you're looking strictly at the MMRI, then this is actually a buy the dip scenario. Right now, we're just basing it upon the MMRI, which is where it's showing that this is a buy the dip situation. There's so many other factors that go into the market. You cannot just look at one or two different indicators. You need to judge which indicators weigh your probabilities and how much. But looking at just one isn't going to do you anything. But if you were kind of confused with Greg when he always talks about the MMRI, this is just a slight explanation.
You should also note that Mannarino, to the day, called the market top when the medical condition hit in March, was it March 19th of 2020? That is, the market took note of it. So the track record, I think, has for something.